My name is Seewing Yee from the Yee Real Estate Network, and my special guest host is Mr. Richard Advani from Supreme Lending. He's the nation's leading investment loan agent. He does financing for real estate investors all over the country, has been doing it a very, very long time. So he has an intimate understanding of financing and the mortgage market, the Fed interest rate, and everything else. So if anybody who's qualified to talk about what's going on in this challenging real estate environment, Mr. Richard Advani is the person. So without further ado, Richard, let me preface by saying, let me mention a couple of things. Okay, I'm going to go over the buzzword, okay? Interest rates skyrocketing, record home price increases, record skyrocketing rents, inflation. So my two questions to you on this 10-minute podcast, my two questions to you is, I know we have no crystal ball, nothing like that, but I'd like to have your comment. Two scenarios I want you to answer. The first quick scenario is, how is this affecting the overall general real estate market, in particular, the primary home buyers, the owner occupied buyers, how is it affecting them? And secondarily, because you and I on a real estate investment game, if you will, this is what we do, how is it affecting the real estate investors relative to what's going on? So without further ado, we love to hear your comment. Go for it.
Yeah, absolutely. So, first thing, all those things you mentioned, right? Inflation, rising rents, rising home prices, rising rates. If everyone who's been watching these for a while has been buying, those are all not bad things, right? That means it's great for us who already invest and already own real estate, right? Higher prices, higher rents, inflation's rampant. So, normally you're like, this is great. And it is great overall. However, of course, when acquiring new real estate acquisitions, which I still am as well, it does change things a little, right? House prices are high, rates are obviously high as well. Rents are catching up, but that takes a little time. So to really answer your question, the big problem that we faced in this country, and it's honestly a global issue, but in this country, let's talk about is, we're on track in the next decade to build half of the homes that we need nationally. And a lot of the increase in home values we're seeing, yes, it's due to, the fact that the real estate market in general appreciates. Yes, a lot of it's due to inflation as well. But, the main thing driving it is supply and demand. And regardless of interest rates, regardless of property value, regardless of all those factors I mentioned, supply and demand is the biggest driver of, an economy and of prices, as we all know. So, the general hunch, and look, I'm not an economist, but, I make it my business to stay on top of this. So I'm always listening to economists and obviously different outlets. And, the general consensus is that, property values in real estate are going to stay strong, at least for the next 3 to 5 years, because that deficit in, available homes isn't going to change. Now, what does that mean for first-time home buyers? Well, I'm sure you heard in the news that home sales are slowing, and, the media just looks for whatever big headline they can throw to, get a reaction out of people. But yes, they're right. It is slowing, right? Instead of 50 offers on every home for sale, there's 25 offers, that's slowing to them. So yes, they are right. It has slowed, but has there been a big fundamental shift in terms of, the amount of people trying to buy each individual property? And whether it's a primary home or a rental, and anyone out there who has bought or trying to buy homes in the last year knows it's the same anywhere in the country. Okay. And that's not really going to change. So, yes, there's been a big pool of primary home buyers that have probably dropped out as interest rates have moved up. They were already frustrated in trying to find a home, right? Everything's bid over. Now rates have gone up. And, as a lender, we have to call a lot of those clients we had pre-approved to say, hey, you know what? Rates have gone up. Now you won't qualify for as much. So imagine you've been looking for a home for a year and a year later, after you spend hundreds of hours looking for a home, your lender comes to you and says, hey, you know what? I know you probably want to go higher on price to find a home, but now you got to go 100,000 lower, right? So a lot of those people have dropped out, which is good. Makes a little less, kind of a little bit less of negotiations and a little bit less of competition. But once again, there's still 20 people in line to buy it. Now, as it relates to investors, obviously I'm very dialed into the investor niche. I've been doing it, well over a decade now. We have noticed a little slowdown, but not much, honestly. What we have seen is there's a different investor replacing the investor that we have been working with, or the investors you and I have been working with have started kind of looking at real estate a little differently. And what I mean by that is, a lot of the new type of investors we're seeing in these last 3 to 4 months are people who have made a lot of money in the stock market, right? They want to diversify. They probably don't own a lot of rental real estate, just their primary home. And where else do you invest right now, right? Inflation's rampant, stock market's peaked out, crypto, gain and loses half its value in 3 days. And yes, rates are high. And yes, your cash on cash return is low, sometimes even negligible. But what a lot of people are looking at real estate as is a hedge against inflation, asset diversification, and really building a long-term wealth building avenue, right? And so what we've noticed is, we have those types of new investors coming in, and our current investor base aren't chasing ROI anymore. Cash on cash is amazing, right? It's a good way to evaluate a property. But I ask people who are chasing cash on cash, even if you make your goal 7% cash on cash return, right? Which sounds nominal, but that's kind of high in this market, believe it or not. Okay, so you're going to make $250 a month. What are you going to do with that, right? What is that cash on cash going to do to change your life? That may pay for one dinner out with friends, if you're lucky, right? So how important is really the cash on cash, right? If you're in your 40s or even 50s and you're retiring 15, 20, 25 years, cash on cash, I don't care about cash on cash. I care about 15 or 20 years from now when I am going to retire, right? What does that investment look like then? And if you picked a strategic market, even though up front there wasn't a huge cash on cash, guess what? A decade later, inflation is going to continue. Rents are going to continue to go up. And at that point, you're going to be accelerating your principal pay down quite dramatically as well. Because obviously a 30-year fixed, every single payment you make, the subsequent payment, you pay a little more principal. So I know this is going very long-winded, but at the end of the day, I don't see a slowdown happening. If you guys are waiting for rates to drop or values to come down or any of that, it's not going to happen. Now, maybe, the competitiveness may have dropped 30%. There's 30% less people standing in line for that single house now. Maybe it'll drop another 20%. But bottom line is, I don't think anywhere in the country you're going to get to a point where you go buy a house in the next 5 years and you're not going to have 5 or 10 other offers. So yeah, rates still are historic low, swallowing almost 6% for an investor or 5+% for a primary home sounds scary to us, but I'm done with this webinar and you're done watching it, go talk to your parents or grandparents and they'll tell you how 18% was an average rate when they bought homes. So, that doesn't make the load lighter, but a lot of people ask me, I'm going to wait now for values to come down. And I'm like, okay, I'll talk to you next decade.
Richard, with that said, you recap it, you summarize it in such a good way. You cover all the points in a mere few minutes. There's really nothing more to say. Investor, anybody listen to this podcast, they're going to play it, they can replay what you just said. Your 2-minute speech, however long you did to take, it just is very clear cut. It's just, there's nothing more you need to say. So really thank you for this comment. I want to say one last thing for our investors, and the type of investors I work with. Instead of putting 20 to 25% down payment, you might want to put 30% down payment at a 6% interest rate, and you can achieve a few $100s of positive cash flow. So, it's again, it's all about, long-term appreciation and all those multiple benefit you're getting when you buy investment property. So yeah, so investors, we look at things differently, right? You put your down payment in 25%, 30% down payment, then everything else hopefully is smooth selling, because everything else is going to be good to go. Your renter is going to pay down all your debts over time, and all the whole 9 yards. So that's all to say. So real investors, my recap is you have to make some adjustments. So the thing is, do not stay on the sideline for the reasons, Richard, what you just mentioned. So full steam ahead, invest cautiously, just steady as you go, and invest for long term, and don't listen to all the negative doom and gloom chatter out there with the internet, YouTube videos, and the media. They all like, it's all crash negativity. It's just avoid those kind of chatter and just focus on your personal investment goals, and steady as you go, take action moving forward. Thank you so much, Richard Advani. Very, very great, quick comment. It should resonate with a lot of people. Thank you so much. This is Seewing Yee. Have a nice day.